Alright, welcome everybody to today's episode. Before we start, we would like to start with God. So let's have a quick prayer. Father Lord, we thank you this morning for your protection and guidance throughout the night. We say thank you, Lord. You are God. You are the omnipotent God. You are almighty. Because of you, I've been able to wake up. I had a plan yesterday, and today you have given me the resources to fulfill the plan. I pray that you strengthen me, you fill me with purpose, you fill me with strength, you fill me with health, and you fill me with wisdom. Perform through me. Help me. I know you have already finished this because you are Alpha and Omega. So help us complete this in your name. Amen. Alright. So today we've started the course again. Last week we did introduction to supply and demand. We already have first introduction to what type of market structure. That we are using for continuation, right? Okay. We have market structure per se. We've done multiple videos on it. But since we are taking the course again, we are starting with market structure. Since we are taking the course again, we are starting with market structure. So today we will start with basic market structure. Today, so we are starting with basic market structure. Okay, so today we are starting with market structure, and due to lack of connection, I cannot add notes. You can see the notes are not coming. The notes are not there. They are not coming. I can't add notes. I don't know why. Alright, so we will have to pay close attention. Since I won't be able to add notes here, you have to pay rapt attention. Okay. Alright, so before I would like to point this out that although market structure doesn't really seem like the juicy part of trading in terms of technical analysis, but it is the major concept that you cannot ignore. Market structure is king. You cannot ignore market structure. It is. You give me a minute. You cannot ignore market structure. It is the ultimate. I don't know how to describe it, but market structure is king, and it is the first thing we analyze. You have to analyze, and as a technical analyst, it is the first thing you have to understand deeply, thoroughly, before you can even advance. And the reason is we will learn multiple concepts. So we will learn about market structure. So let's use We learn about market structure. So let's use MS market structure. We will learn about supply and demand. We will learn about supply and demand. We will learn about liquidity. So we will learn about these things as technicals. Then we will combine them together as a strategy. So these are individual concepts, and within market structure, we have a lot of concepts within market structure that we are going to get into. But today, let's just start with basic market structure. So basic market structure. Basic market structure. What if you are starting with the basic or the fundamentals of structure? Then you have to know and identify what structure is. So what is structure? In the definition, structure is a high or low in the market. Is the high and low in the market. The definition is high and low. It is not high or low. So your structure is the high and low. Listen to this definition carefully. The main word I want you to understand, or I want you to place emphasis on, is end. Because people think the price or market move up and down. They think price move up or down. So it is either we are going up or we are going down. But price move up and down. It actually moves up and down. Yeah, it moves up and down. So even within this one, we are moving to the downside, but you will see that there are up moves within. And yeah, so market structure is the high and low in the market. High and low in the market. So this one, you can see this is the high. This will be your high. This will be your low. This will be the last low. This will be the final low that we have, because there's no low. This will be a high. We can identify here to be on a high. Here will also be a high. All of this will be highs, and all of this will be lows. So market structure refers to the highs and lows in the market. Highs and lows in the market. When these highs and lows come together, they form something called a trend. When these highs and lows come together, they cause something called a trend. So a trend is a series of, or a connection of market structure. And we have identified, or we have defined that market structure refers to the highs and lows in the market. So now we have to connect, we have to do this connection. Highs and lows in the market is structure, and a trend is a connection of structure, meaning a connection of highs and lows. Good. So there are two types of trends that we have in the market. There are two types of trends that we have in the market. We have either we will be moving to the upside, or we will be moving to the downside. So we have two types of structures in the market. We will either have a bullish structure, or a bearish structure, and don't worry, we will define them in a minute. So you have either bullish structure or a bearish structure. So you either have this where a bullish structure is also known as an uptrend. A bullish structure is also known as an uptrend. So when price is moving to the upside, why is price moving to the upside? I hope by the end of this video you have an understanding as why bullish in the bullish structure price moves to the upside and what we do with that information. Alright, so this is what you will see. A bullish structure is a type of market structure characterized by higher highs and higher lows. A bullish structure is a type of structure characterized by higher highs and higher lows, where generally price is moving to the upside. Listen to the definition very well. So bullish structure is characterized by higher highs or higher lows, so a high or low, but it is moving to the upside. It is an uptrending market. When you see something like this, you identify your high. Here is a high. Now you identify the structure. Here is your high and here is your low. Alright, so this will be your last high, and then price breaks this high to form a higher high. So the logic behind this higher high is that price is all the price is moving to the upside, and we had a high here. Price has even broken this high and has created an even a higher high. Price has broken the high and has created an even a higher high. So you identify this higher high at the top, which will be your new high, right? And then here will be your new low. So it is characterized by this. So when you get an even higher high, you expect this low to be a low, but it will be lower than the last low. So even though it is low, it is higher than the last low. So we call it higher low. So in the bullish market structure, the lows are called higher lows. Here, higher lows, because the lows keeps getting higher. That is why we see trend lines and things. The lows keep getting higher. So here you see that you even get a higher high. So when this happens, we say that we are in the bullish market structure. When this happens, you see that we are in the bullish market structure. So the definition is it is characterized by higher highs and higher lows. So this here will be your here will be your high. You have another high here. You have another high here. So this area here, when you get a break of this higher high, it is called a boss. BOS. Boss, not BOSS, but BOS. A boss. A boss in the market structure means a break of structure. Simple, a break of structure. So here is a break of structure, here is a break of structure, here is a break of structure. One break of structure, two break of structure, three break of structure. But you don't identify them as one break of structure, no. You just identify them as boss. So when you get this, when you get to this move here, when you get to this move and you break this, when you get to this move and you break this, we identify here to be a boss. Here will be our break of structure. So here will be our break of structure. And here, give me a minute. Give me a minute. Nice, nice. Okay, so here will be our boss. Here will be our block of structure. Now, I've gotten a mouse, so you will be nice. Yeah, let's go. Alright, so here you get a block of structure, our boss. So keep it in mind, a boss. Here will be a boss. Here will be a boss. Here will be a boss. And aside the boss, here will be a higher high. Here will be a higher low. Here will be a higher low. Here will be a higher high. Here will be a higher high. You get the point? Here will be a higher low. So in a bullish structure, the definition is that it is characterized by these higher lows and higher highs, and you learn why you call them these higher lows and higher highs. So they are characterized by this. If they are characterized by this, when price is coming to the downside, you know that it won't break this low, and this low will hold. It will form this higher low, and we will continue to get this boss, and then we continue to get this boss, and here will be our higher high, and here will be our higher low. Am I clear? Alright, so this is the bullish structure. Then you continue with bearish structure. Bearish structure. So in the bearish structure, you can see that it is the opposite, the direct opposite of a bullish structure, and it is characterized by lower lows and lower highs. So here price will make a low, and then you break this low to form even a lower low, that is lower than the last low, right? So we'll be doing this, and then this one will be your high, this one will be your low, this one will be your LL, this one will be your lower high. So the lower high, the analogy is that even though price will move to the outside and to create a high, sometimes it can create a double high, double top. It won't go higher than the last high, right? So although it is higher, it is lower than the last high, so it is higher low, and then you get this even the lower low in a bearish market structure. So that's your definition of bearish market structure and bullish market structure. So yes, you have already identified a connection of these structures are called a trend. Connection of those structures are called a trend. And another principle that I would like to point it out in basic market structure is that after a break of structure, we expect a pullback on that same time frame. After a break of structure, we expect a pullback on that same time frame. So after a break of structure, this is a principle that you have to keep it in mind. It's like it's like God. You didn't see God, but you have to have faith and accept Him that He's there, right? The same as this. Although if we reach liquidity, if you read these advanced concepts, you will see maybe even supply and demand. You will see why we are expecting this pullback, and when we are expecting pullback to how do we expect the pullback to behave. We can even predict all of this in advance, but with basic market structure, Just keep it in mind that after a break of any structure, you expect a pullback on that same time frame. After a break of a structure, you expect a pullback on that time frame, on that same time frame. So if we break a structure, if this trend is on the 4-hour structure, and then we break it, when we break it, we have to expect a pullback on the 4-hour time frame. We don't expect the pullback on the daily or on the 15 minutes. We have to expect a pullback on the daily or on the 4-hour, on the time frame that you go to break. So if you get this break, you will be waiting for this pullback on this time frame. So if you go to the, let's say, 15 minutes and you see some move here, it's not a pullback until we get this 4-hour pullback. That's when we transfer here to be the pullback, and here will be the last low, and we continue the move. Alright, so this is bullish and bearish. And after a break of any structure, we expect a pullback on that time frame. After a break of any structure, we expect a pullback on that time frame. After a break of any structure, you expect a pullback on that same time frame. So let's continue. What we are going to learn is that these bullish structures will be characterized by borderlines. It is not just one line like this. And this is what you are going to see. So when you are in the market, you see that should I identify where to be my high, or my swing, my new bullish high and the higher low, or should I identify? Because reality, price looks more difficult than this. So you will see something like this. Let's say the swing structure, you get this break, and you get some structures within, something like this. Break. It is not the quite. It is not just this straight line. It is not just this straight line. So in reality, you have to zoom out. It's another principle. You have to zoom out to see the borderlines. And this borderline that we are talking about is what we call a swing point. So the swing highs and lows. So in a swing high is the highest point. That's called the swing low. And the swing low is the lowest point. That's called the swing high. So a swing high is the highest point. That's called the swing low. And a swing low is the lowest point. That's called the swing high. So it is self-explanatory if you are looking at this. Here we are swing high because it is the high that caused a low, and this will be a swing low because it is a low that caused this high. Here will be a swing high because it is a high that caused a break of it is a high that caused a low. This will be a swing low because it is a low that caused this high, this swing high, and this swing high will be a swing high because it will form this swing low, and you expect this here to be our swing low because it will form this a swing high. Cool. Let's assume that this structure, this low, it will be this, and we have this much lower structure, and we continue like this. When this happens, you know that when this happens, here is not our swing low. Here is not our swing low, but rather here is our swing low, and here is not our swing high, but rather here is our swing high. So if you are zoomed in, you won't see the right thing. Like, oh, here is the swing high and here is the swing low. But when you do this, it will be a bearish structure. No, you are wrong. But because here, this is the swing low. Here, this will be a swing low, and here will be a swing high. So within this, you see the last low. Remember the definition. A swing low is the low that's called the swing high. So within here, you see the last low that caused this swing high, and it is not this. It is not this one, but rather this one. Alright. So this in a bearish structure, it will be the same. So the swing low will be here. A swing high will be here. Here will be the swing low because it's called the swing high, and here will be the swing low. Here will be a swing high because it's called the swing low. And here will be a swing low because it's called the swing high. Here will be a swing high because it's called the swing low. So this is it, even because of these swing structures. So in the bearish structure, let's assume we are having this pullback. Remember, after we get this break, although you can see in this particular example, after we get this break, you can see that price continues to move for a long time. But you have to keep it in mind that you see this one, when we made this, we didn't keep on for long, and we had our pullback. We didn't keep on for long, and we had our pullback, See, this one, we have kept on for a long time, and still want to keep it in mind that pullback can happen. Still, we have to keep it in mind that pullback can happen, and we're expecting this pullback. So let's assume that this pullback is now happening, and here will be your swing high. And since this one is happening, here you can't classify here to be a swing low until it caused a swing high. So imagine here this happens, and you do this, then you can then we do something like this. Within this room, where will be our swing high and where will be our swing low? Within this one, here will be our swing high, here will be the highest point. This area will be the highest point, here will be our swing high. This area will be our swing low, right? We have this swing low here, because the swing low, so we have a swing low, and then you expect this pullback. So within this pullback, we were expecting it, and within this pullback, where will be the last high, right? The last high within this swing high and then swing low. Where is the last high? So this will be the last high. The swing will be a swing high. It is a swing high because it caused a swing low, right? It is a swing high because it caused this swing low. So when you get a structure like this will be a swing high, this will be a swing low. Although this is a swing high and a swing low, now this will be a current swing structure. A current swing structure. Here will be a current swing structure. Please get this. If you want to repeat this area, repeat it as much as you can, or watch it over and over again, because it is very important, and this will help you get in on the right side of the market a lot of the times. Keep it in mind. You have to keep it simple. And simplicity is the ultimate complexity. So you have to see this high as a swing high, and this will be a swing low. Now currently, this will be a current swing high because it has caused a swing low. So here will be your boss in this case. Here will be your boss. Here will be your boss. Boss means break of structure. So in this situation, where was our last low? In this situation, where was our low? Where was our low? Now here will be our lower high. Here will be our lower high, and here will be our lower low. If you start this pullback, here will be our lower low, and this will be a bearish structure. But this will be our swing high, our swing structure. Our swing high will be here, and our swing low will be here. So mapping swing structure is the most crucial part of mapping structures of the market. Any structure within the swing high and low are all internal structures. So this is very important, because we have already identified that market structure is king. Market structure is king. Market structure is king. It is the ultimate foundation. It is supposed to be the backbone. Market structure is king. But we know that within market structure, swing structure is king. So although swing structure is like the prince, right? And we know that the prince have power, the son and the father have power, right? So yeah, swing structure is very important to know and understand. So this will be a swing structure, and there will be a swing high and a swing low, and you see this swing structure. And we will say that from this swing high and this swing low, any structure that you see in this higher high and this higher high and this higher low that you see, when you are too zoomed in, remember I've already said that you have to zoom out. When you are too zoomed in, you might think this is a bullish structure, and yes, it is a bullish structure because it is making a series of higher highs and higher lows. It is making a series of higher highs and higher lows. If you are too zoomed in, you might think naively that this corrective structure is a bullish structure. But no, in the overall sense, it's a bearish structure, because the swing structure, if you are bound this swing structure correctly, you will identify that here will be a swing structure, here will be a swing structure, and here will be a swing low. So anything that is happening within here is an internal structure until we break this, until we break the high, right? So until we break the high, anything within here will be an internal structure. Anything will be an internal structure. Okay. So this is good. This is good. I think it is going well. If you have any question, you take your time to think about certain things. So in a bullish structure, until price breaks the swing low, trend remains bullish. Until price breaks the swing low, trend remains bullish, and we will expect the swing high to get broken and continue to get a higher high. In a bullish structure, so let's put our bullish structure back. In a bullish structure, until price breaks the swing low, trend remains bullish, and we will expect the swing high to get broken and continue to get a higher high. So in a bullish structure, we expect this continuation. In a bullish structure, we expect this continuation. In a bullish structure, we expect this continuation. Remember, in a bullish structure, we expect this continuation. We expect the high to get broken and the low to hold. We expect the high to get broken and the low to hold. And if this happens, the trend remains bullish. But imagine here, the trend remains bullish and still the boss remains at the highs. But imagine here this happens, Christ comes and we bring this. When we bring this, now we can't, we have the swing low has broken. The swing low, the good structure that caused the swing high that we were expecting not to get broken has broken. So in the good structure, when a low gets broken, the trend changes obviously, and you will get much more into trend change later. But in a good structure, we don't expect the low to get broken. So the moment price remains above here, even until here, still we don't expect sellers or bearish structure. We expect bullish structure to continue because price can still form a double bottom. Right, you can form a double bottom here and continue the move to the outside. But if that thing doesn't happen and price continues to break this, if the candle body close, then this one will be a boss. Right, here will be a boss. So then here will be your boss. Here will be your boss, and here will be your high, your swing high. So here will be a swing high currently instead of here. So in the bullish structure, the swing lows are in the bullish structure, the swing lows are not supposed to get broken. Why, we will get into that much later. But in the bullish structure, the lows are supposed to be held, or they are supposed to hold, and if they get broken, trend changes. But as long as they remain above here, that is bullish. So in the bullish structure, until price brings the swing low, which is this one, the swing low, trend remains bullish, and you expect, and this is the main thing. The moment it breaks here, our expectation changes. But as long as price is above here, our expectation is that we will continue to get a higher high. We will continue to get a higher high. So this is for bullish swing structure, and the same as a bearish structure. So in the bearish structure, as long as the swing low stays intact, in the bearish structure, as long as the swing high stays intact, we will expect the bearish structure to continue to form a lower low. So in the bearish structure, as long as this swing high stays intact, we will expect this price to continue to form a lower low. So price can come here, test this zone, even break it. Right, through this liquidity, we won't classify here to be a big, unless you build in the kind of body place. We won't classify it to be a trend change, and we will still expect price to turn around and get to this. And what at that time, whatever is happening here, that belief that is happening will be an internal structure. And we expect price to continue to form a lower low, right? So after a break of structure, we expect a pullback on that same time frame. We've already pointed those out. Okay. So strong structure. Now we are getting into the juicy part. We will finish right now. Strong structure and weak structure. So let's recap before we jump into strong structures and weak structure. Let's recap. We've talked about we've talked about basic market structure. We talked about impulsive and continuation. We talked about bullish and bearish structure. We've talked about swing structures. And we are saying that in a bullish structure, price will continue to make higher highs and higher lows. Until we get this higher low broken. Until this higher low gets broken. Until this higher low gets broken, we expect price to continue to create a higher high. Until this swing low gets broken, we expect continuation. But the moment this swing low gets broken, trend changes and we expect this one to happen. A pullback and a continuation to form even a lower low for this bearish structure to continue. That's the bullish structure. In the bearish structure, we expect this lower lows to form and for higher highs to stay intact and for lower lows to get broken until we get this structural breaks here. When we get to this structural breaks here that's when we get the real confirmation that trend is continuing, and we expect trend continuation unless you get a break of this structure here. So imagine after that pullback started to happen, we finally broke above this. So this will be a structure. This will be, although it was a bearish structure, now it has transitioned to bullish structure. It has transitioned to bullish structure, and now we need to expect this low to get broken. Although in the bearish structure we expect this low to get broken. Now we need to expect this low to get broken again. We expect this rather high to get broken for the bullish to continue. Alright, so that is what you've learned, and that will be a swing structure, because a swing low, because it's called a swing high, and here will be a swing high because it's called a swing low. Here will be a swing low because it's called a swing high. Here will be a swing high because a swing low. Here will be a swing low because it's called a swing high. It will be the same as bullish, this swing low causing a swing high, and this swing high causing a swing low. Please get this, understand this. This is the reason why we ignored the market. The chart is there, but we have ignored this, and we are using these lines to explain things, because in the real world, when you get into this, it is not as normal like you see it. This even you see the more reason in the trend changes when we are seeing this. Now let's see, we have seen this. You might think this is a bearish structure. Let's see. Now this is the bullish. Okay, now this is the bullish structure. Now you can see this. You see, so there's so much going on. But how do you understand? Okay, now you are seeing this. How do you make money? You have to understand what is going on at the top here. You have to understand what is going on here. If you can understand what is going on here, now we are talking, right? This is the basic. Now so let's continue with the strong structure. I've pointed it out that in the bullish structure, we don't expect the swing low to get broken. Right? We don't expect the swing low to get broken. Why? The reason is that in the bullish structure, the lows are strong and the highs are weak. In the bullish structure, the lows are strong the highs are weak, the lows are strong, the highs are weak. So why is the lows a strong low and why is the high a weak high in the bullish structure? Why? The reason is okay. So then why is the lows strong in the bullish structure? A strong structure, by definition, is a structure that breaks another structure. So remember, we already established that after a break of any structure, we are expecting a pullback, and we are saying that it is a principle that just accept it, that after a break of structure, we are expecting a pullback. If this is it, then it means the break, definitely there will be a break. The breaks happens, and these breaks, where these breaks happens, will give us the idea as to whether we are bullish or the swing structure is bearish or bullish. Where the swing highs, the highest point is the swing high, the lowest point is the swing low, whether in bearish structure or bullish structure. So here this will be a swing high and this will be a swing low. But the same here will be a swing high and here will be a swing low. But where you are expecting that swing low to get broken is what differentiates whether it is a bullish structure or a bearish structure. So in a bullish structure, we expect the highs to get broken. This is why we see this, and we didn't expect this one to get broken. This is why we get these higher lows and we get these even higher highs. But in a bearish structure, we expect the lows to get broken because the lows are weak and the highs are strong. The lows are weak, the highs are strong. The lows are weak, the highs are strong. The lows are weak, the highs are strong. So we will be expecting these lows to get broken. We will be expecting these lows to get broken. This is what we will be expecting. Now, it didn't happen. It didn't happen. And in this case, this strong structure gets broken. When a strong structure gets broken, trend changes. When a strong structure gets broken, trend changes. When a strong structure gets broken, trend changes. So in this situation, we can see that here will be our swing high, right? Here will be our swing low, and here will be a strong swing structure. So now it is a strong swing structure, which is the strongest swing structure. Then expect it to get broken because in the bearish structure, the lows are weak, the highs are strong, and this high has caused a burst. It has caused a break of structure. So if you have caused this burst, this swing low or this swing high will be a swing low, will be the swing high. So this will be a strong swing structure because it called this swing break of structure. So we didn't expect this one to get broken, but imagine here that is pulling back. We expect something like this to happen because this one is a strong structure and this is a weak structure. For trend to continue, it is the natural expectation, and it is called the expectational order flow. Expectational order flow. Maybe when we get to supply and demand and order flow, we understand this one much better. We understand this one much better. But we understand this one much better. But for now, let's keep it in mind. Let's keep it in mind that This is the expectation in the berry structure. You don't expect a strong structure that's called a swing load to get broken to fail. So the expectation is you expect this structure to hold. You expect that one to hold. You expect this one to hold. So this is it. This is the strong structure. So in the bullish market structure, the lows are strong, the highs are weak. You can see here the highs keep getting smashed. Those are keep getting the higher highs. The highs keep getting smashed. So here when price comes here, you won't expect this one to get broken. This is the expectation of that flow. The expectation is that this one will continue, and when you get the break of structure and you get this pullback, you won't break here and you continue the move, right? With the expectational order flow, right? This is the expectational order flow. So until here, let's say this happens, and break this low. When we break this low, here will be our swing high. Here will be our swing high, not here or here, because this one is the one that causes this break. So here we are swing high. So here is the swing low. Here is the swing structure. So we are doing this structure, and this is the swing high, the swing point that caused this. Here is the swing point, the highest point that caused this swing low. So when we do this, then we identify the highest point again within this that caused this low, right? So this one will be a swing point, this one will be a swing high. Same continuation. So it is just simple as that. Just keep it as simple as that. And the moment the strong structure gets broken, trend changes. So when now we have switched from bullish, so expectational order flow has disrupted. Trend changes and a disrupted expectation order flow. So in the actual sense, we are waiting for or expecting the bullish to continue, and we are expecting this higher low to form, and for this one to get smashed. But here it didn't happen, and this pullback continued to break this low. So now here will be our strong structure because it caused a low. Here we are showing our swing structure because it caused a low, and after this swing structure week, trend will change from bullish to bearish. And now since the strong structure is here, remember in the bearish structure the highs are strong, the lows are weak. We expect this one to happen and the lows get broken because the lows are weak, the highs are strong. So this is the anatomy of trend change. This is the basic market structure. Yeah, so a high job is to create a low job is to create a high. So a high job is to create a low, is to create this low. A low job is to create this high. It is as simple as that. That if create this, the way they are simple as that. So the moment you get a first book of structure in the opposite direction, Trend is confirmed that yeah, we have changed trend. We have changed trend. So this is the end. This is the end. This is the end. Like before we end everything, let's do this thing. Let's do a recap. Let's do a recap. So this is the recap. For you see a building structure, moving to the upside, and we expect price to continue the upside movement because the highs are weak, and this is a strong structure. This is a strong structure. Eventually, although price will continue the move, eventually you get a break of structure. You get a strong break of structure, and when you get a break of structure in the opposite direction, trend will change. The expectation of that flow will now shift from bullish to bearish, and in the bearish structure, the highs are strong, so we expect this pullback, but we don't expect the pullback to pull back past the same strong high in the bearish structure. We expect this one to get broken. So this is basic market structure. Remember, structure is this high and low in the market. The trend is the connection of those highs and lows in the market. Bullish structure is the uptrend characterized by this outside movements. Low structure is characterized by lower lows and lower highs, and the lows are weak. Since the lows are weak, the lows keep getting smashed. That's why we keep getting the lower lows, and the swing high is a high that's called the swing low, and the swing low is a low that's called the swing high. A strong structure is a structure that broke another structure, and a weak structure is a structure that failed to break another structure. So a structure, highest job is to form a low. If the high job fails to create a low, the high will be a weak high. If the highest job fails to make a low, it will be a weak high. If it does the job, it will be a strong high. So yeah, this is the introduction or theory side for basic market structure. So we will end here. Next will be the walkthrough, the practical side. So this will be our first lesson. Thank you.